Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to intangible asset, that is Indian Accounting Standard 38. We deals with intangible asset. What do you mean by intangible asset? We had studied intangible asset in our old accounting standard AS 26, which is applicable on some corporate and non-corporate entities having a net worth less than 250 crores. Then on that, the old standard AS 26 is applicable. Today's we will discuss about Ind AS 38, which is more or less almost similar with IFRS 38, that is IAS 38. This standard Ind AS 38 is the mirror of IAS 38. So let's start our Ind AS 38. Firstly, we will discuss the agenda of the standard. What we will discuss today, that is objective and scope of intangible assets. What do you mean by intangible asset? That is very important. The definition of intangible asset. Definition of intangible asset means what intangible asset is, that asset which we cannot touch, we cannot feel, like tangible asset, like land and building, like property, plant and equipment. They are the tangible asset which we can touch and feel, and also we will determine some future economic benefit from that asset. In case of intangible asset, that we cannot feel and touch that intangible asset, but we will determine the future economic benefit from that asset. We will realize the future economic benefit from intangible asset, but we cannot touch and feel that asset. Means intangible assets does not have any physical existence. So, like we can say that goodwill is a kind of intangible asset, and also SAP, Tally software, all these softwares which are used for accounting purpose, softwares which we will use in our business purposes. So these softwares are kind of intangible assets for the organization, and also some franchisees, some copyrights, trademarks, and all mining rights, license. All these are the examples of intangible assets. Let me take the example like IBM. This type of organization, Siemens, they are manufacturing the SAP. For that, the SAP is an inventory. But like MRF, like Bajaj Auto, they are installing that kind of SAP in their organization to run the accounting system. So for MRF, for Bajaj Auto, the SAP is not an inventory, it's an intangible asset. So it's a kind of example for which company, the company who is manufacturing this kind of software, for them it is an inventory, but the company which are using this kind of software to run their business, for them it is an intangible asset. So intangible assets are this. And one more example is like in case of business combination, like company A acquire company B, and company A acquire all the assets and liabilities of the company B, and in purchase consideration, the company A pay 100 crores and acquire asset and liability of 80 crores. So the differential amount which the company A pay to company B, that is 20 crores, is the amount for the future economic benefit which the company A use from the assets and liabilities of the company B's, that is the goodwill. So the extra amount which the company A pay to company B, that is the goodwill. So goodwill is also an intangible asset, and then we will discuss about the recognition criteria, how this standard helps to recognize intangible assets in the books of account. Then we'll discuss about the initial recognition, how we will recognize initially the intangible asset in the books of accounts, and also in the books of the companies, initial recognition and measurement criteria. Then we will discuss about the mode of intangible assets, like mode of acquisition, how the company will acquire the intangible asset in the form of business combination, or in the form of acquisition in the form of government grants, or it is an internally generated intangible assets, or it is an exchange of asset, like in which form the company has acquired the intangible asset. So we will discuss this in detail. Then we will discuss about the subsequent recognition, means at the end of each year after recognition, after initial recognition, at the end of each year, how we will recognize, what entry we will do, like we will follow the cost model or we will follow the revaluation model, which model we will follow after means initial recognition. Then we will discuss amortization and useful life of intangible asset, and then we will discuss about the how we will, in case of what we will do in case of impairment of intangible assets. Then we will discuss the disclosure, how we will disclose that. So this standard generally deals with the objective and scope, the definition of intangible asset, the recognition criteria, initial recognition and measurements, mode of intangible assets, subsequent recognition, then amortization and useful life of intangible assets, then impairment of intangible assets, if any, and then disclosure. So this is the agenda of this standard, and we will discuss step by step. So firstly, we will discuss about this objective of these standards. The objective of these standards, these standards generally prescribes or deal with the accounting treatment for intangible assets, that is, which are not dealt in another standard. The accounting treatment which are not dealt in another standard is prescribed under this standard, the accounting treatment for intangible asset. Then we will discuss about the recognition criteria. The objective of these standard is to how to recognize the intangible asset, what was the criteria to recognize the intangible asset. Then we will check that how to find out the carrying amount, that is the carrying amount of asset, intangible asset, that is the cost of intangible asset minus amortization minus impairment, if any. Amortization is, there is a three form of depreciation. Like in case of tangible, we can call it as a depreciation, and in case of intangible asset, we call it amortization, and in case of like minerals and all, we will call it as a depletion. Uh, these are the three names of depreciation, and then we will discuss about the disclosure. So these are the objective of these standards, and then we will discuss about the scope. This standard generally applies with all the intangible assets except the financial asset. Like financial assets is a kind of intangible asset, we can't see it, we can't touch it, but it's like an investment, it's a kind of paper only. All the assets are purchased or sold in a demat form, there is no physical existence for that. But this is not an intangible asset, because these financial assets are in the form of intangible, but uh, there is a separate standard to deal with financial asset. Like Ind AS 32 generally talks about the financial assets, so these assets are out of the scope of intangible asset. So these are Financial assets, there is a separate standard to deal with, that is Ind AS 32, exploration and evaluation assets. Firstly, we will, what do you mean by exploration? What do you mean by evaluation? There is a separate standard to deal with, like Ind AS 106 generally talks about the exploration and evaluation asset, how to deal with this kind of assets, but this standard is specifically does not says about the exploration and evaluation asset. It generally deals with the exploration and evaluation right, the license which is given by the government, the right which is given by the government to the company to explore or evaluate asset. Like in a government has given some rights to dig out the exploration or oil to the ONGC to extract oil from mining areas. So that oil which the company dig out, that exploration and evaluation of that oil and keeping in some area, some places, that is called as an exploration and evaluation asset, and there is a separate standard to deal with, that is Ind AS 106. But the right which is given by the government is dealt under this standard only. The exploration right, the evaluation right is dealt under this standard, but the asset which the company will explore by digging that mining areas, like exploring of ores, coal or oil, whatever they explore from that area, mining areas. So that asset, that dig out the mountain which we that they create from that ores, that mining dig out mines, uh, or that oil which they generate by digging out, so that are known as an exploration and evaluation asset, and there is a separate standard to deal with, that is Ind AS 106. And if any expenditure on development and extraction of mineral oils or natural gas and similar resources, so there is a separate standard. 106 generally talks about this kind of exploration and evaluation, but the right which is given by the government to explore or evaluate is dealt under this and as 38. So now, intangible assets arising from insurance contract issued by the insurance company. There is a separate standard, that is 104 generally talks about. So these kind of intangible asset arising from insurance contract are out of the scope of Ind AS 38, because there is a separate standard which talks about this kind of assets. So 104 talks about this kind of intangible asset arising from insurance contract. Then there is a intangible asset which are covered by another standard, such as intangible assets held for sale. So there is a separate standard 105. Deferred tax asset, there is a separate standard Ind AS 12. Lease asset, there is a separate standard Ind AS 116. Asset arising from employees benefit, that is Ind AS 19. Goodwill Ind AS 106. Held by entity for sale in the ordinary course of business Ind AS 2. And asset arising from contract with customer, that is Ind AS 115. So these are the scope which deals with this kind of accounting, uh, except some of the followings which we had discussed. Now comes definition of asset. What do you mean by an asset? Asset is a resource controlled by entity as a result of past event resulting in future economic benefit is expected to flow. Asset is a kind of resource which is controlled. Asset is managed by entity as a result of past event resulting in future economic benefit that is derived or that is expected to flow to the entity. means any future economic benefit that is derived from that asset or that is expected to flow to the entity is an asset. It's a kind of resource which is controlled by the company. So this is the definition of asset. Before going into the definition of intangible asset, we had discussed the definition of asset. Now, definition of intangible asset. What does it says? Intangible assets is an asset that is not physical in nature. As we had know that intangible assets in we cannot touch the intangible asset. We cannot means there is no physical existence of that intangible asset. The intangible asset is not physical in nature, but the economic benefit which derive, the future economic benefit derived from that asset, the asset is identifiable, the asset is controlled by the company, by the entity, the asset is resulting in a future economic benefit to the company, but there is no physical existence of that asset. So intangible asset is an asset that does not have any physical in nature, such as patent, brand, trademark, copyright. All these are the examples, like patent, brand, trademark, copyright. All these are the intangible asset, does not have any physical existence, but still they are an asset. Business can create or acquire intangible assets. The intangible asset can be considered as indefinite, a brand name, for example, or definite, like a legal agreement or contract. So, intangible asset can be considered as definite or indefinite. In case of indefinite intangible asset, like we can say the brand name, it's an indefinite intangible asset, and definite like a legal contract or legal agreement. Now, intangible asset created by a company do not appear on the balance sheet and have no recorded books value. So, created means self-generated intangible asset. If the company can create their own intangible asset which do not appear on the balance sheet and have no recorded book value. This is very important definition of this standard, that is definition of intangible asset, which we will discuss in detail also. Like example of intangible asset, like we can say that software Tally, ERP9, SAP, accounting and tax related software. All these database, trade secrets, customer list, all these are the intangible assets. They are the examples of intangible assets. Suppose the IBM are creating a software. They are manufacturing a software. That software is an inventory for them. But Bajaj Auto, Bajaj has told IBM to create software for them, for any ERP software or SAP software or accounting or tax related software created by IBM for Bajaj Auto. For Bajaj Auto, that software is a intangible asset. It's not an inventory for them, but for IBM it is an inventory. Then goodwill, that is we all know the recognition in business combination. Suppose if the company A merge with company B, or company A amalgamate with company B, so any consideration paid by company A to company B, extra consideration paid by company A to company B, that extra consideration is termed as a goodwill. Then we will, the example of intangible assets are copyrights, marketing rights, mortgage servicing rights. It's a kind of right which is provided to the company. Then patents, then trademark, trade dress, newspapers, internet domain, spectrum license. These kind of licenses on geographical basis. So telecommunication service, the government has provided a spectrum license to the telecommunication industries on geographical basis. So this is that type of to run their business. So spectrum license, then brand, franchisee, then video and audio visual materials. This may include television programs, motion pictures, customer and supplier relationships. All these are the examples of intangible assets. Then we will discuss about the features and characteristics of intangible assets. Because intangible asset does not have any physical substance, it does not have any physical existence which we can feel, which we can touch, which we can hold. So, like tangible asset, we cannot feel, touch, and hold the intangible assets. So, it does not have any physical substance. We only realize the future economic benefit from that intangible assets. Costs can be measured reliably, and the definition of intangible asset should be met. And also, intangible assets are non-monetary asset. Why they are non-monetary? What is the difference between monetary and non-monetary? Before going into the definition of non-monetary asset, we firstly understand the difference between monetary and non-monetary asset. Monetary assets are what? They are highly liquid. Monetary assets are highly liquid, easily converted into cash. That are the monetary assets. Monetary assets are that asset that is readily or easily converted into fixed amount of money. But non-monetary assets are those assets that cannot be readily convertible into fixed amount of in a immediate short term. Like we can say land. We cannot sell land in a short term basis, or it cannot be said as a liquid, highly liquid asset. So plant machineries like goodwill, copyright, patent, PPE, investment property, biological asset, inventory, all these are the type of non-monetary assets. Monetary assets that are easily convertible into cash, like cash, bank balance, cash and cash equivalents, like fixed deposits, account receivable, loans receivable. Means exactly we know that by selling that we can generate money, or we can get cash from that. So that kind of assets are termed as a monetary assets, that is converted into fixed amount of money. These assets have a high liquidity in terms that describes how fast an asset can be converted into money. Means how fast the asset can be converted into money. A number of tangible and current assets falls into the category of monetary assets. Means tangible and current asset. Tangible and current asset falls into the category of monetary. Some of the current assets falls into the category like account receivable, loan receivable, and all these other monetary assets. And non-monetary assets are not so liquid. Monetary value of such assets fluctuates and change frequently over time, and is illiquid in nature. It is illiquid in nature, that assets are highly fluctuate and change frequently over time. And monetary assets are fixed, means the monetary terms are fixed, but in case of non-monetary, the amount of cash which they will generate are not fixed, they are fluctuating in nature. Suppose we had inventory, we have an inventory which are kept in our godown. Whether it is that inventory, until and unless we sold that inventory, is able to generate cash, no. When the inventory is located in our godown, it is a non-monetary asset. But when we sold that some amount of inventory, then we will able to generate cash from that inventory. We are readily the inventory is readily convertible into cash. We know that we will generate uh, that amount of cash from by selling that inventory. So until and unless the inventory is located or situated in the godown, kept in the godown, it is a non-monetary asset. When that inventory is sold to the market and able to generate cash, then only we will say that the inventory, when sold, is said to be a monetary asset. So this is the difference between monetary and non-monetary. And so intangible asset does not have any physical substance. It is a non-monetary asset because not easily able to generate cash. Then it is identifiable. An intangible asset is taken as identifiable if it can be separated or originate from any contractual or legal right. There is two condition of identifiable, that is it whether it can be separated, the asset can be separated from other asset, or it is originated from any contractual or legal right. If any of the conditions satisfied, then it is said to be as an intangible asset. Identifiable intangible asset. So it can be separated means separated. The definition of separated means either you can sold, transfer, license, rent out, or exchange such intangible asset. Then it is termed as a separated. Thus, you can do so either individually or together with a related contract. And such intangible asset originate from any contractual or legal right. This is irrespective of the fact if such right can be transferred or separated from your business or from other rights and obligations. So intangible asset is said to be identifiable when it can be separated. There is a two criteria for that, that is separated or originate from contractual or legal right. If any of the criteria meet, then it is said to be an identifiable intangible assets. And what do you mean by the separated? Separated means it will be sold, exchange, transfer, license out. Then only it is said to be the intangible asset is said to be separated. So type of intangible, identifiable intangible asset, that is there is a many type like marketing related and identifiable assets, and then artistic related, then contract related, then technology related. So these are the types of identifiable intangible asset which we will discuss along with the example. So market related identifiable intangible assets are: marketing related intangible assets are primarily used in the marketing, which is used in marketing or promotion of product. Means any intangible asset which is used in marketing or a promotion of any product or service. So that kind of asset are treated as a marketing related intangible. They are typically protected through legal means and therefore generally meet the contractual or legal criteria for recognizing separately as an intangible. So they are typically protected through legal means and therefore generally meet the contractual or legal criterion for recognizing separately as an intangible asset, like trademark, trade name. Trademark and trade name having a contractual legal right or separation criteria. These two are the So it is the trademark or trade name is a market related identifiable asset which fulfill the criteria of contractual or legal rights, because trademark or trade name or other marks are often registered with governmental agencies, or whether they are registered or unregistered but otherwise protected. Whether registered or unregistered but otherwise protected, trademark or trade name and other marks have some legal protection and would meet the contractual legal criteria. So they are meeting the contractual legal criteria because they have registered or unregistered with the governmental agency. And if they are not protected legally, but there is an evidence of similar sales or exchange, the trademark or other marks would meet the separation criteria. So if they are protected, then they are having a contractual legal rights, and if they are not protected, then they have a separability criteria. Then comes another example of marketing related identifiable asset, that is trade dress. Trade dress is what? They have a unique color, shape or packaging designs. That is termed as a, some companies are trading their product, are supplying their product, but their packaging style, the product which they are packaging, the color which they are selecting, the shape which they are giving to their product are extremely unique. So that uniqueness is termed as a trade dress. So it's a kind of intangible asset, that is market related intangible asset. So trade dress refers to unique color, shape or packaging of a product. If protected, if that trade dress is protected legally, then that trade dress meets the contractual legal contract criteria. In if that trade dress does not protected legally, does not have any protected legally, or does not have any legal evidences, but there is an evidence of sale of the same or similar trade dress asset, or if the trade dress is sold in conjunction with related asset such as trademark, then it would meet the separability criteria. If they are protected, then they are having a legal or contractual rights, and if they are not protected, then they meet the criteria of separability. Then newspapers, then internet domain, all these are market related identifiable intangible assets. In case of newspapers, are generally protected through legal rights similar to trademark and therefore meet the contractual legal criteria. And if they are not protected legally, a company would look at whether exchange or sale of newspapers occur to determine if the separability criteria is met. Means if they are protected, then they have a contractual legal right. If they are not protected and having whether there is an evidence of sale of that newspaper fulfill the separability criteria. Internet domain is also an example of marketing identifiable intangible asset. Internet domain names are unique name used to identify a particular internet site or internet address. These domain names are usually registered and therefore would meet the contractual legal criteria. So these are the contractual legal rights, and so it is a identifiable asset. Whether the identifiable asset meets the criteria of contractual or legal right, or it meets the criteria of separability. Then there are another type of identifiable asset, that is contract based. Contract based intangible asset represent the value of rights that arise from contractual arrangements or agreements. The customers are the one type of contract based intangible assets. They are customer contract. There is a contract between the customers. So these customer contracts are one type of contract based intangible assets. There some of the examples are licensing, royalty, standstill agreements. These are the contractual legal rights. And then another example is advertising, construction, management, services or supply contract. These are the contractual or legal rights. Then lease agreements, then construction permits, then franchisee agreements, then operating and broadcast right, use right such as drilling, water, air, mineral, timber cutting and route authorities, servicing contracts and employment contracts. These are the contractual or legal rights. The value of rights arises from contractual arrangements. If any value of rights arises from contractual agreement, then that in identifiable asset are considered as a contractual based identifiable intangible. These are the examples, and then we will discuss about the artistic related intangible identifiable intangible assets. That is, artistic related intangible assets are creative assets that are typically protected by copyrights or other contractual and legal means. Means any creative assets are termed as a artistic related, like for example copyright, which are protected by copyrights or other contractual legal rights, legal means. Artistic related intangible assets are recognized separately if they arises from contractual or legal rights such as copyrights. The examples of artistic related in identifiable intangible assets are, which are contractual or legal based intangible assets, that are play, operas, ballets, books, magazines, newspapers, other literary works, musical works such as composition, song lyrics, advertising jingles, pictures and photographs, video and audio visual materials, including motion pictures, music videos, and television programs. These are all artistic related, which are protected by the copyrights and having a contractual or legal means. These are intangible assets, artistic related, identifiable intangible assets. Now, the another example type of then there are some technological based intangible asset. Identifiable intangible asset, the another type of identifiable intangible assets are technology based. For example, patented technology, and these are acquired on the basis of contractual legal rights or on the basis of separability criteria. Patent like patented technology, research and development, computer software and mass works, unpatented technology, database including title plants, trade secrets such as secret formulas, processes and recipes. These are the technology based identifiable intangible assets. Then customer related identifiable intangible assets are, the example of customer related identifiable assets are like customer list. They are based on acquired on separability criteria. Then order or production backlog on the basis of contractual or legal rights. Um, Customer contract and related customer relationship on the basis of contractual or legal rights, and non-contractual customer relationship on the basis of separability criteria. So these are the types of identifiable intangible assets. And then This is to be explained with the help of example. Suppose Venus Limited intends to open a new retail store in new location in the next few weeks. Venus Limited has spent a substantial sum on a secret. Means Venus Limited wants to open a new retail store in a new location in coming week, and the Venus Limited has spent a substantial sum on a series of television advertisement to promote this new store. They had spent a lot of amount on advertisement to promote this new store which they are opening in new location. The company has paid an amount of 8 lakhs for advertisement before 31st March 2021. Rupees 7 lakhs of this sum relates to advertisement shown before 31st March 2021, and rupees 1 lakh to the advertisement shown in April 20, means after 2021. Means before 31st March they had spent rupees 7 lakh, and after 31st March they had spent rupees 1 lakh to the advertisement. Since 31st March 2021, the company has paid for further advertisement costing rupees 4 lakh. So these are the expenses they had incurred on advertisement. Venus Limited is of view that such cost can be carried forward as an intangible. Since market research indicates that this new store is likely to be highly successful, please explain and justify the treatment of above cost in the financial statement for the year ended 31st March 2021. We will explain the solution. Intangible asset can only be recognized if they are identifiable. There are some criteria, like only when the assets are identifiable asset, they meet the definition of intangible asset, and the cost can be measured reliably. Then only the asset is to be recognized in the books of accounts. These criteria are very difficult to satisfy for internally developed intangibles. So if the intangibles are internally developed, so it's very difficult to find out the cost, and then to find out whether it is an identifiable asset, or and also they are fulfilling the condition of intangible. For this reason, Ind AS 38 specifically prohibit recognizing advertising expenditure as an intangible asset, because India's 38 specifically, because it is very difficult to very difficult to satisfy the criteria for internally developed intangibles. So it's very difficult. So India's 38 specifically prohibit recognizing advertising expenditure as an intangible asset. The issue of how successful the store is likely to be does not affect this prohibition. Therefore, such cost should be recognized as an expense. Means advertisement expense is not treated as an intangible asset, because Ind AS 38 specifically prohibit the advertisement expenditure to consider the advertisement expenditure as a intangible asset, because they are not fulfilling the criteria of intangible asset. If the advertisement is not separately sold, if this advertisement is already expended, the expense on this advertisement is already done, but we cannot sell this advertisement separately. It is not fulfilling the definition of identifiable intangible assets, and nor it is having a contractual or any legal rights. So these are not advertisement expenditure not fulfilling the definition of intangible assets, identifiable intangible assets, and thus they are treated as an expenditure, not as an intangible asset. The cost will be recognized on an accrual basis. company follow mercantile system of accounting, so cost will be recognized on accrual basis. Therefore, advertisement paid before 31st March, that is 7 lakhs, which is of that year expense, is to be recognized in that year, and 1 lakh which is prepaid in the year ended 31st March recognized in the next year, because it is a prepayment expenses, but the expenses is related to next year, so it will be recognized in the next year. And rupees 4 lakhs cost of advertisement paid since 31st March 2021 would be charged as an expenses in the year of 31st March 2021 only. So the expenses which is related to that year is to be recognized in that year, and which is related to next year is to be recognized in the next year only. So this is the illustration, and advertisement expense is not to be considered as an intangible asset because it is not fulfilling the definition of identifiable asset. Identifiable intangible asset, because there are two criteria to fulfill the definition of identifiable intangible assets are, that is, firstly they have contractual or legal rights, and the next one, the contract is to be separate, criteria is to be fulfilled. So both the criteria is not fulfilling in this case, so it is treated as an expense. The definition of intangible asset itself is very vast. It says about, firstly, it is an asset who does not have any physical existence. Secondly, it is a non-monetary asset. Thirdly, it is an identifiable intangible asset. Fourthly, it is controllable by the company. The asset which is controlled by the company and having a future economic benefit. The entity should arise or recognize or realize the future economic benefit from that asset. Then that asset is to be treated as an intangible. So it's the definition is very important and very vast. So means itself it says about now next is the controllable. What do you mean by controllable? You control the asset if you hold the power to receive future economic benefit from that particular asset. For example, if you have any asset, intangible asset, and the entity should have the power to receive future economic benefit, to receive the future economic from that asset, then that asset is to be controlled by that entity. Also, you limit the access of such economic benefit to others. Means that asset is not accessed by others. So the entity should have the power to arise economic benefit from that asset, and also have the power to limit the excess of such economic benefit to others. Furthermore, your control over the future return from intangible assets originate from legal rights. Legal rights. These rights are enforceable in court of law, and however, the legal enforceability of your rights does not necessarily give you control over the asset. These rights are enforceable in court of law, and the legal enforceability of your rights, the power the entity should have, the right should does not necessarily give you the control over the asset. Generally, the legal enforceability does not give the power to the entity, the controlling power to the over the asset to the entity. But if they have the power to receive future economic benefit from that asset, and if they have the power to limit the excess of such economic benefit to others, then only it is said to be the entity should have a control over the asset. This is because you may control the future return from intangible asset in some other way. This is to be explained by example. Suppose we know that human resource is an asset to the organization. If one company incur some training cost to their staff. They did not stop that employee to leave the organization. They did not stop the employee to use their training to other. You are not able to use this training in other organization. They do not stop that. So this staff training cost, which is considered as an intangible asset, whether this cost is considered because they don't have a controlling power over the employee. The training which they had incurred on the employee, the training cost which they had incurred on the employee, the training they had given to the employee, the company did not stop that employee to leave the organization. The company does not have the power to stop the employee to use their knowledge in other organization. So these staff training cost will not be considered as an intangible asset because there is no controlling power over the asset. The company will obtain the economic benefit from the work performed by the staff as it is increase the efficiency, but it does not have. The company can, though as per the definition, the company will receive the benefit, the future economic benefit from that staff because the work they perform, the company will obtain economic benefit from the work performed by the staff as it increase the efficiency, but it does not have the control over them because staff could choose to resign the organization at any time. So therefore the company lacked the ability to restrict the access of others to those benefits. Therefore, the staff training cost does not meet the definition of controllable intangible. So, in order to meet the definition of controllable intangible asset, firstly, the entity should have the power to receive economic future benefit from that asset, and secondly, they restrict the limit to access the economic benefit which is arises to from that asset to others. So these 2 points are important for meeting the definition of controllable intangible capability of generating future economic benefit. Intangible asset may give your business future economic benefit in a variety of ways. This may include revenue from sales of goods and services, cost saving, and other benefits arising from the use of assets. Means from the use of asset, the company will able to generate future economic benefit in variety of ways, like sale of goods, revenue from sale of goods, from sale of services. In order to save cost, saving of cost is also a future economic benefit, and other benefits arising from the use of, like for example, use of intellectual property in production process may reduce future production cost. Means intellectual property, if the entity will use intellectual property in production process, it will reduce production cost, and indirectly it is a kind of cost saving rather than increasing a future revenue, because cost saving is also a future economic benefit. It also generates a future economic benefit in the form of cost saving. So it's also a kind of benefit that flows to the entity. Now, recognition criteria. What do you mean by how these standards deals with intangible? How these standards says about the recognition criteria? How intangible asset is to be recognized by following this standard. Recognize various type of intangible assets if they meet the following criteria. There is some criteria. If the criteria meets, then only the intangible asset is to be recognized in the books. This is irrespective of whether the company purchased or self-created such assets. Whether the intangible asset is purchased or it is created, self-created intangible asset, it does not matter. If these criteria meets, then it fulfill the definition, and then the company will recognize an intangible asset. Firstly, the possibility that your business entity would receive. Firstly, by using this intangible asset, there is a possibility that business entity would receive the future economic returns from that intangible asset. Means there is a possibility that business entity would receive the future economic return from intangible asset. The cost of various type of intangible asset can be measured reliably and should meet the definition of intangible asset. Remember, these recognition criteria applies to both self-created or intangible assets acquired externally. These recognition criteria applies both to self-generated or intangible asset acquired externally. However, there exist additional criteria for self-generated or internally generated intangible asset. Furthermore, possibility of future economic return flowing from such intangible asset must depend on valid assumption. These assumptions must be with regards to circumstances existing over the life of the asset. So, irrespective of these means these criteria is applies to both self-generated and also the intangible asset acquired externally. There is some additional criteria for self-generated or internally generated intangible assets. So these are the recognition criteria. Firstly, future economic benefit flows to the entity. Secondly, cost of various it can be measured reliably. And thirdly, should meet the definition of intangible. Then after that, mode of acquisition. How the entity should acquire these intangible assets. These intangible acquisition of such assets is by way of separation acquisition, by way of separate acquisition, by way of business combination, if they are acquired by way of in the form of business combination, then by way of government grants, if the goodwill is generated or intangible asset generated internally by the organization or through exchange of assets. So these are the mode of acquisition. Firstly, we will discuss about the cost, meaning of cost, how the company will recognize and at what cost the company will recognize the intangible asset. Cost includes purchase price in case of separate acquisition. In case of, because separate acquisition is to be recognized at cost. What is the definition of cost? In case of intangible asset, cost includes purchase price, including import duties and non-refundable purchase taxes after deducting trade discounts and rebates. And also, cost also includes directly attributable cost of preparing the assets for intended use, like cost of employment benefits, employees benefit, professional fees, cost of testing, which is directly attributable to that asset. Without that cost, without incurring that cost, that asset is not able to use. The entity will not able to use that asset without incurring that cost. So that cost is important, and which is the cost which is directly attributable for the use of that asset, so are also included in the cost of intangible assets. And also it does not include any decommissioning cost or dismantle cost, because intangible assets are those assets which does not have any physical substance. So there is no requirement of dismantling because they does not have any physical substance. the asset which does not have any substance, physical substance, so how could the entity will dismantle? So dismantling cost is not included, or decommissioning cost is not included, advertisement cost is not included, promotional expenses is not included, administration cost is not included, and other general overhead cost is also not included. These are out of the scope of the definition of cost of intangible asset. Only cost that is purchase price including import duty, non-refundable taxes, purchase taxes, less trade discount, less rebate, and if any cost which is directly attributable for its intended use, that cost is to be. Now, deferred payment credit. What do you mean by deferred payment credit? If payment for an intangible asset is deferred beyond normal credit terms, its cost is the cash price equivalent at the recognition date. Means deferred payment is like an we say it's a kind of installment. It's a kind of installment payment basis. Let's take the example of Infosys. Government said to Infosys to develop an income tax portal, and the government is ready to pay rupees 1 crore 64 lakhs to the Infosys to build the new income tax e-filing portal. So they had paid on a deferred term basis. But if the cost of paid portal, if paid on cash basis, it will incur 170 crores. Means if it is paid on cash basis, the portal, the government said that if I will pay you on cash basis, then the cost will incur, that is 170 crores. But if I pay you in an 3-4 installment, or after 2 years or after 5 years, then the cost will increase. Then the cost will increase. Then that time the cost will be 200 crores, and the difference of 30 crores, which is charged as an interest or finance cost in the books of government. So it is due to deferment of payment, because instant payment, if we pay instantly, the cost will reduce, but if we defer our payment, the cost of that asset will increase because of the time gap. So this is known as a deferred payment credit. If payment of an intangible asset is deferred beyond normal credit term. Normal credit term is means suppose 6 months, 3 months, 2 months. It's a normal credit term, and if there is a deferment of payment beyond normal credit term, then it cost is the cash price equivalent at the recognition date. In cash payment is deferred beyond normal credit term, difference between cash price equivalent total payment is recognized as an interest over the period of credit unless such interest is capitalized. When this interest is to be capitalized in case of qualifying asset. In case of qualifying asset only, this interest is to be capitalized. Otherwise, it is to be charged as an expenses, as a finance cost. Now we are discussing an example on separate acquisition, that is intangible asset valued at cost. In case of separate acquisition, intangible assets are valued at cost. So this is the illustration related to separate acquisition. Like XYZ Limited purchases software for its internal use at a cost of rupees 15 lakhs, out of which 11 lakhs paid immediately and 4 lakhs are paid after 1 year. So this is a case of deferred payment. So other costs incurred which are in relation to purchase of softwares are purchase tax rupees 2 lakh, entry tax is 15%, that is recoverable later from income tax department. Recoverable later from tax department, that is entry tax is 15%, which is a recoverable tax, and legal fees is rupees 90,000. Consultancy fees for implementation of that software is 2,40,000 and cost of capital at the rate 10%. So calculate the cost of software on initial recognition. How we will recognize, at what cost we will initially recognize using the principles of Ind AS 38, that is intangible asset. By following the principle of Ind AS 38 intangible asset, at what cost the software is to be initially recognized. So this is the illustration, and the solution is, as we know that the immediate cash payment on purchase of software, that is purchase cost is 15 lakhs, and out of which 11 lakhs is to be paid immediately. So cash paid is 11 lakhs, and we have to find out the present value of that 4 lakhs which is paid after 1 year. So we will find out the present value, that is 4 lakhs is paid after 1 year. So we will find out the annuity factor of that, that is 1. The cost of capital is 10%. So 4 into 1 divided by 1.1. So it will becomes 3 lakhs 64,000. That is 3.64. The differential amount is, that is 4 lakhs is the amount which is paid due to deferment, that is after 1 year, and 3.64 is the present value of that amount. So if the company will pay fully in cash today, then the value of that asset will be 3.64, and the differential amount is the interest part. Now purchase tax, which is non-refundable, as it is not mentioned in the question whether it is a refundable or non-refundable. So we are assuming it as a non-refundable tax, and we will include in the cost of intangible asset. So purchase tax 2 lakh, legal fees will become 90,000, consultancy fees for implementation is 2,40,000. So total cost is to be recognized as an initial recognition cost, which is to be capitalized, that is 19.94 lakhs. So the accounting entry will be intangible asset account debit 19.94 lakhs to bank account or vendor account, and the differential amount, that is due to deferment of deferment, that is 4 lakhs which is paid after 1 year, and the present value of that is 3.64. So the differential amount is to be treated as interest expense account debit 0.36 lakhs to vendor. In case of separation acquisition valued at cost, in case of business combination, intangible asset acquired in case of business combination always valued at fair value, because all the assets and liabilities which is to be acquired in case of business combination is to be, because the purchase consideration is at fair value, on asset and liabilities to be valued at fair value. So it is they follow the fair value at the time of acquisition in case of business combination. So the example will be, on 31st March 2022, Neptune Limited paid rupees 80 lakhs for 100% interest in Moon Limited. Means Neptune Limited paid because Neptune Limited acquired Moon Limited. So Neptune Limited pay 80 lakhs for 100% interest, with the 100% holding in Moon Limited. At that date, Moon Limited Net asset fair value is the fair value of the asset of the Moon Limited is as on that date, on the date of acquisition will become 50 lakhs. And the purchase consideration which the Neptune will pay for the asset and liability which they acquire for asset and liability of Moon Limited, they are going to pay 80 lakhs for the asset and liability of 50 lakhs. In addition, Moon Limited has also the following rights. Moon Limited has some of the rights like patented technology, which is valued at 2.80 lakhs using a discounted cash flow techniques. Franchisee agreement, future cash flow which are estimated to be 3 lakhs per annum for the next 6 years. For next 6 years, the future cash flow estimated to flow to the entity are 3 lakhs per annum. 10% considered an appropriate discount rate, and the 6 years 10% annuity factor is 4.36. Firstly, we will calculate the goodwill, and it also said how the other intangible asset arising on acquisition. So, other intangible assets are firstly the differential amount is the goodwill, and other intangible assets are, that is patent technology is an intangible asset. Franchisee agreement is also an intangible asset. So the purchase consideration will be 80 lakhs. Net asset acquired is 50 lakhs. Another intangible asset, that is patent technology, which is already discounted. So we will take 2.80 lakhs. And franchisee agreement is 3 lakhs per annum for 6 years. It is estimated that the company will receive the future economic benefit from that franchisee agreement 3 lakhs per annum for a period of 6 years. So 6 years annuity factor is 4.36. So we will multiply with 4.36, 3 lakhs into 4.36. So it becomes 13 lakh 8,000. So the total will be 65 lakhs 88,000. So purchase consideration minus total assets at the time of acquisition is 65 lakhs 88,000, and they are going to pay 80 lakhs for that. So differential amount will be 14 lakhs 12,000. So it becomes a goodwill. The higher amount which the company is going to pay for the asset and liability, that difference is treated as a goodwill. Now, acquisition by way of government grant. If the company acquire intangible asset by way of government grant, and in case of government grant, the cost is to be valued either free of cost or at a concessional price. Government, if the intangible asset is acquired from government either free of cost or at a concessional price, then how the company will treat that intangible asset in the books of accounts. An intangible asset may be acquired free of charge or for nominal consideration by way of government grants. This may happen when a government transfer or allocate to an entity intangible assets such as means these intangible assets acquired free of charge or at nominal consideration by way of government grant. This may happen when government transfer, when the government is ready to transfer or allocate to an entity any intangible right such as airport landing right. So license to operate radio or television station. If the government is provided any license to radio or television station to broadcast in order to broadcasting, so the government has provided the license to radio and television station to broadcast their programs, so it's free of cost or at a concessional price. So this is also treated as and also import license or quotas or right to access other restricted resources. These are the rights given by the government at a free of cost or concessional price. So how the counting entry is to be done? In case of free of cost government grant intangible assets, or in case of a nominal price. In accordance with Ind AS 20, accounting for government grants and disclosure of government assistance, an entity should recognize both the intangible assets and grant initially at fair value. If the entity choose not to recognize the asset initially at fair value, the entity recognize the asset initially at nominal amount. Firstly, in accordance with Ind AS 20, that is accounting for government grant, an entity should recognize both the intangible asset and also the government grant at a fair value. But if the company choose not to recognize the asset initially at fair value, the entity recognize the asset initially at a nominal amount. Nominal amount means rupees 1. The other treatment permitted by Ind AS and any other treatment plus any expenditure. The if the grant is given at a concessional price, means at a nominal value without any price, or at a free of cost, or if any expenditure incurred in order to prepare that asset for its intended use, means any directly related expenditure, then is to be recognized at a nominal value plus that expenditure incurred for use of that asset, means the asset prepared, the expenditure which is incurred or attributable to prepare that asset for its intended use. Example 1, option 1. Recognize government grant and intangible assets at fair value. Firstly, recognize government grant and intangible asset at fair value. In option 1, if government grant and intangible assets are recognized at fair value, then what was the example? If the government has given a license to operate radio or television station to the company for 5 years, and the fair value of such right is 40 lakhs, then both government grant and intangible assets are to be recognized at fair value. That is, the accounting entry will be license to operate radio or television station, that is intangible asset account debit 40 lakhs to deferred government grant. Because it is for 5 years, so it's deferred government grant at the time of acquiring license. And during the year, there is two entry, that is amortization, because license is to be amortized for a period of 5 years, so it becomes 8 lakhs amortization account debit to license to operate radio or television station, that is intangible account credit 8 lakhs. And these liability defer government grant is also reduced over a period of 5 years. It is credited in the PL account every year as other income. So deferred government grant account debit, that is 8 lakhs to other income, because over a period of 5 years the company is receiving that grant in order to operate the radio station rights, the license to operate. If the company will operate that license up to 5 years, then the grant is to be they will receive a grant over a period of 5 years. So that liability is to be, again it becomes a income. So deferred government grant account debit 8 lakhs to other income. And in the second option what, the if the company will recognize intangible asset at a nominal cost plus directly attributable cost if any incurred. So government has given license to operate radio or television station to the company, but will charge rupees 10 lakhs for its registration. Means for registering some expenses incurred, or then that expenses is to be treated as a directly attributable cost. So license to operate Nominal means right. The right is given at free of cost, but the cost which is incurred to use that asset, that is to be debited or capitalized with the asset. So license to operate radio or television station intangible asset account debit, that is 10 lakhs to bank account, because in expense incurred at the time of acquiring license. And in case there is no such expenses incurred at the time of acquiring, then it will be recognized at a nominal value, that is rupees 1. License to operate radio or television station intangible asset debit, that is rupees 1 to other income. It is treated as and charged to PL as other income. Exchange of intangible asset acquired in exchange of other intangible asset. One intangible asset in case of barter system, that is exchange of intangible assets. If intangible asset is acquired in exchange of other non-monetary assets, or in exchange of monetary or non-monetary assets, means in exchange of other intangible assets or in exchange of non-monetary, exchange of combination of monetary and non-monetary asset, means suppose one intangible asset is exchange, like trademark is exchange in exchange of some copyrights, or some copyrights and also in cash, then that is the monetary and non-monetary exchange. If there is having a commercial substance, so if the asset is acquired and that asset is having a commercial substance, then the asset is recognized at a fair value of the asset which is surrendered, means which is exchanged. Suppose one trademark is exchanged in exchange of copyright. So the exchange, the asset which the company A is surrendering, the fair value of that asset is to be taken for recognition purpose. And if fair value of asset surrender means given up is not available or not identified, then asset is to be recognized at a fair value of asset acquired. In case fair value cannot be determined of asset given or asset acquired, if both the fair value is not determined, then asset is to be recognized at WDV of asset surrender. And if the transaction does not having commercial substance, asset is to be recognized at cost, means WDV of the asset surrender. Let's take the example. Suppose XYZ Limited acquired a trademark from ABC in exchange of import license, means XYZ acquired a trademark of ABC company in exchange of its import license, means XYZ is having an import license and ABC Limited is having a trademark, and they exchange their asset with each other. The carrying value of import license at the date of exchange, at the date of acquisition, is 8 lakhs in the books of XYZ Limited, and the trademark is carried at rupees 50,000 in the books of ABC Limited, which is not the fair value. Which is not the fair value, it's a carrying WDV. Advise journal entries in the following situation. There is the in the question 3 situation is given. That is, then we will find out what journal entry we will recognize in different situation in the books of XYZ Limited and the books of ABC Limited. Like in first situation, the fair value of trademark is given, that is 4 lakhs, and fair value of import license is given, that is 10 lakhs. In both the cases, means fair value in this case, both the assets, the fair value of both the asset is given, that is asset acquired and asset given up. Firstly, what we will check, firstly we will check the fair value of asset surrender. So we will firstly take the books in the books of XYZ Limited. which asset is going to surrender. Like import license, they are going to surrender and they are acquiring a trademark. XYZ Limited is acquiring a trademark and they're surrendering an import license. So, firstly, we will check the asset given up, asset surrendered, the fair value of asset surrender. We will recognize that. In first situation, the entry we will pass like fair value of asset given or asset acquired is provided. So, fair value of asset given, that is fair value of trademark is 4 lakhs and fair value of import license is 10 lakhs. So asset surrender is import license in case of in the books of XYZ Limited. So trademark which we are acquiring, the company is acquiring the trademark is debited by the fair value of the asset surrender. So the fair value of asset surrender is 10 lakhs. So trademark is to be recognized at 10 lakhs and they will credit the import license. Then the WDV of the import license is as on the date of acquisition is 8 lakhs and the differential amount is to be whether it is a profit or a loss is to be recognized. In this case, there is a profit because trademark which the company is acquiring is recognized at a fair value of asset surrender, so it becomes 10 lakhs and the import license is to be credited by 8 lakhs, so the differential amount is to be profit on exchange, that is 2 lakhs. In the same way, in the books of ABC Limited, they are acquiring an import license and they are surrendering a trademark. So they will debit the import license with the fair value of asset surrendered. In this case, the asset surrendered is trademark and the fair value of asset surrender is 4 lakhs. So it will be debited by 4 lakhs and the WDV of the trademark will become at the date of acquisition is 50,000. So the differential amount is to be profit on exchange, that is still at 50,000. So in the same way, the for in this case both the fair value is to be given. So we had passed the entry accordingly, and if either of the fair value of the asset is given or asset acquired is provided, means any of the asset given or asset acquired is provided, then what was the situation? The second situation, if the fair value of trademark is not measurable, is not given, and however the similar import license is transacted by another company at rupees 7 lakhs, means fair value of trademark is not given but the fair value of import license is given at rupees 7 lakhs. So how we will recognize? So the company is acquiring the trademark and it's surrendering an import license. So firstly we will check the fair value of asset surrender. In case of XYZ Limited, the fair value of asset surrender is 7 lakh. It is given, so trademark account debited by 7 lakhs and the value WDV of the asset is asset surrender is that is import license is 8 lakh. The differential amount is loss on exchange which is debited. So in case of ABC, in the books of ABC Limited, the asset surrender will be the asset surrender is trademark and the asset acquired is import license. So import license is to be debited by, firstly we will check the fair value of asset surrender. So in this question the fair value of asset surrender is in the books of ABC Limited, the fair value of asset surrender is not given. Then we will go for the second step. We will go for asset. We will check the fair value of asset acquired. In this case, the fair value of asset acquired is given, that is 7 lakhs. So we will take that for recognition purpose. So import license account debited by 7 lakhs. To trademark, that is the WDV, that is 50,000 and the differential amount will be treated as profit on exchange, that is 6,50,000. And the third option will be if the fair value of asset given or asset acquired cannot be determined, then it is to be recognized at a WDV of the asset surrender. So trademark account debit, that is asset surrender is import license, and WDV as on that date the carrying value is 8 lakhs. So it trademark account debit 8 lakhs to import license. And in this ABC, the asset surrender will be trademark, though WDV will be 50,000. So import license account debit to trademark, that is 50. This is the intangible Ind AS 38 which we had discussed today. Some of the concepts are still pending, so we will discuss or we will complete this in the next session. Thanking you for watching my video. If you like, please subscribe, comment and share.